Let's get to some of your calls. Overweight US stocks, EM, Japan, high yield credit. What aren't you overweight right now in this market?
Yeah, so we're not overweight cash, and I love your quote that I saw on one of the monitors that said T-bill and chill. That's like nails on a chalk. I'm probably dating myself with this reference, but that's like nails on a chalkboard for me. John, I'll tell you, we still run into that problem, and I'm not talking about should you be in equities or should you be in cash, okay? I'm a multi-asset portfolio manager. I believe in diversification. And a diversified portfolio last year, when the Fed wasn't cutting rates, was up 16, cash was up 5 on the year. This year, this diversified portfolio is 60-40 is up about 11, and cash is up about 3.5. So we're tripling the return on cash for folks that should probably be in diversified portfolios. And I loved last Friday morning at 10 a.m. The time has come for policy to adjust. I mean, that's like music to the ears of investors after 2 very long years. 2022 it was the economy's going to have to go through some pain in order for us to achieve our dual mandate. I still remember pain. And then last year it was basically the message was we're either going to be high for longer or even higher for longer. So I think what we're looking at when we believe the momentum in equities can continue is that these cuts, I think, are going to grease the wheels for the soft landing. And, you know, the Fed cutting without a recession and what we believe between 4 and 5% nominal GDP growth, every investor should be raising their hand for that.
For a while, the sales team, I imagine at JPMorgan, were calling clients and saying, you really should get out of cash. We've got this bond fund. Allocate some long-dated debt. Go into credit. All sorts of things with Bob Michael and co. Have some fun. Are they calling you now, after Friday, to make that move? How resistant have they been? Yeah,
the credit story is still loud and clear. Because the credit story for us is we'd rather play offense in fixed income than defense. So the high yield story, while spreads aren't super wide and we're not going to get this crazy total return, we'll get the total return in equity, John. But we're going to out yield what we believe treasuries and just the core bond funds can do over time, which is a form of alpha. Less glamorous than NVIDIA, but it is a form of alpha. But importantly, like this diversification story, what we've seen is that as soon as inflation hits 3 or below, and we're at 2.9 on CPI, you get the right way correlation back with bonds. So you can get a day like August 5th, the highest intraday volatility in the history of the equity market, my first day of vacation, thank you very much, and we can hold on to our overweight to stocks and credit in that environment because we believe that finally bonds are going to be the diversifier that we expect them to be.